Panera invented the thing that every restaurant has copied. Real silverware, comfy booths, a fireplace, and food that is just elevated above everything else. This was revolutionary in the 90s. Now sales are falling, stores are closing, and the CEO admits that it's because they've cut costs everywhere. But here's the part that tells you everything. The company with the word bread in their name stopped making their own bread, and this is why nobody's eating at Panera anymore. To understand what went wrong, we have to understand how big of a deal Panera actually was. It starts in 1987. A guy in St. Louis takes a trip to San Francisco and falls in love with the sourdough out there. So then he returns home and opens a bakery called St. Louis Bread Company, grows it to about 20 stores. In 1993, he sells the company to Avon Pond for $23 million. Remember that number because we're gonna come back to it. They rename it Panera, and then they do something nobody was doing. Think about what eating out looked like in the late 90s. You had sit-down restaurants with waiters, and you had fast food with plastic trays. There was no in-between. Panera built the in-between. Real silverware, ceramic plates, big comfortable booths, a fireplace, and a sandwich shop. You could sit there for 3 hours and no one would bother you. They basically invented fast casual and then everybody stole it. Chipotle, Sweetgreen, Cava, every one of those places is running a version of the Panera playbook. That's how good this company was. It was so good that its ideas became the entire industry. Then 2017 happens. A private company firm called JAB Holdings buys Panera. $7.5 billion. Takes the whole company private. Now go back to that other number. $23 million in 1993. $7.5 billion in 2017. That's the entire rise of Panera in 2 numbers, and it's genuinely an incredible business story. But here's what I want you to sit with for a second, because this is the hinge of the whole story. When somebody pays $7.5 billion for a business, that company can't just sit there. It has to get earned back every year, and you can earn it 2 ways. You either grow or you cut costs. Growing is hard, cutting is easy. And pretty quickly after that sale, the new owners started making money-saving changes like most private equity companies do. Normally, this is the part of the video where I'd be speculating, where I'd say, well, the food probably got worse and people probably noticed. But I don't have to speculate here because the CEO of the company came out and flat said it. He's on record saying the company has to put serious money back into the quality of the food because the cost cutting that came before degraded everything, including the ingredients. That's their own guy. That's not me. And when he was asked what went wrong, his answer was, quote, "Death by 1,000 cuts." I love that phrase because it explains something people struggle to put their finger on. Nobody woke up one day and decided to stop going to Panera. There wasn't a scandal, and there wasn't this one special moment. The sandwich just got a little smaller, the chicken got a little worse, the price went up $2, and then it happened again and again and again. And one day you're standing at the register holding a receipt for soup and half of a sandwich, and something in your brain just goes, this isn't for me anymore. That's 1,000 cuts, and it shows up in the numbers. Sales slowed after COVID, and in 2024, they went negative. Down 5%. Okay, now we come back to the bread. Panera used to run its own dough factories. They called them fresh dough facilities. Regional plants scattered around the country, making the actual dough that went into the bread that every store sold. That was the point of the company. It's in the name. And they're closing all 9 of the facilities that they have left. That's about 399 people losing their jobs across Maryland, Ohio, Illinois, and Massachusetts. And what replaced it is something called par-baked dough, which means it shows up cooked, pre-made by somebody else, and your Panera just finishes it in the oven. Now, to be fair, the company says this is actually an upgrade. They say that it means working with specialist bakers to increase quality and improve consistency at every location. And this might even be true, but their own CEO admitted that the rollout was one of the worst communication disasters the company has ever had. Because the second it got out, the story just wrote itself. The bread company stopped making the actual bread. So that's the customer side. Let's talk about the part almost nobody covers, which is what all of this looks like if you're the person who actually owns one of these. And I've got Panera's own franchise disclosure document, or FDD, right here. So these aren't estimates. These are the real numbers that the company audits and puts out into the public. To open a standard Panera, what they call the core format, the total investment runs from $1.3 million to about $4.5 million. And here's the part that got me. That range excludes the real estate. That's before you've bought or built the actual building. The franchise fee itself is about 50 grand, which sounds like the big number until you look at everything else above it. And you can't just buy one. Panera primarily sells multi-unit deals, and the minimum is 2 bakery cafes. So the real entry ticket is roughly double what I just said. Then once you're open, here's what comes off the top every single month. 5% royalty off of revenue, 4% national ad fund, 2% for local marketing, and another 0.4% marketing fee. Add it up, and you're at over 11.5% off of your sales before you've covered a single loaf of bread and an hour of labor or $1 of rent. Now here's where it gets interesting. Panera does something most franchises won't do, and they actually disclose profit. Their average company-owned bakery cafe did about $2.8 million in gross revenue last year. And after food and paper costs and operating expenses, they report average EBITDA of $543,000. That's roughly a 19% profit margin. And on the surface, that's a great number, 500 grand in profit per store. But read the footnote, because the footnote is where the truth lives in these documents. That profit figure is for their company-owned stores, and the document says in plain English that it does not include the royalties that franchisees would pay or banking costs to lenders and financiers. So think about what that means. Take that $543,000 in profit and subtract 11.5% on the $2.5 million in revenue that you did to cover the royalties and other fees off the top. Now subtract the loan payment you made on the $1 to $4.5 million you took out to build the place. That beautiful profit number is not the number you're taking home. It's the number they take home on a store where they don't pay themselves a royalty. And then there's the number that actually decides whether you make it or not. The average franchisee-owned Panera did $2,541,000 in net sales last year. Genuinely strong, higher than most brands I look at. But an average is a story with the ending torn out. Because in that same document, the range of those franchise stores goes from $463,000 at the bottom to $5.8 million at the top. That is nearly a 13-to-1 gap. Same brand, same menu, same ovens, same napkins. And only 45% of franchisee stores even hit that average. So more than half of the owners are underneath the number everybody quotes. And here's the detail I found buried in their FDD that ties this whole video together. Panera notes that a store's cost of sales can vary considerably depending on whether it sits in an area that one of those fresh dough facilities I mentioned earlier sits or not. Read that again. The dough plant closures we talked about 10 minutes ago, they show up in the franchise disclosure document as a cost risk to the owner. The bread decision isn't just a customer story. It's also living in the franchisee's P&L. Now I want to be fair here because this isn't a funeral. Panera is fighting back, and there's a turnaround plan called the Panera Rise program. Refresh the menu, push value, fix the guest experience, and grow their store count, believe it or not. They've opened 23 new cafes this year with about 25 more coming online. And they're targeting over $7 billion in system-wide sales by 2028. Over the last 16 years, they've opened more stores than they've closed, and $2.5 million a store is not a dying business. So the real question isn't whether Panera survives. It probably does. The question is whether you can win somebody back after you've spent 8 years cost-cutting them into oblivion. Because trust is the one thing you can't put back on the menu. Panera didn't lose to a competitor, it lost to its own math. $23 million to $7.5 billion in 30 years. And the bill for that last number got paid in ingredients, in dough plants, and in the $463,000 store at the bottom of that range. Nobody made one big mistake. They made 1,000 small ones, and the customer felt every single one of them. You can cost cut your way to a better quarter, but you cannot cost cut your way to a better restaurant. So what do you actually do with this if you're thinking about buying a franchise? 2 things. First, find out who owns the brand and what they paid for it. If a private equity firm bought your franchisor for billions, the price has to get earned back, and it gets earned back out of the product and supply chain or you. You're not just buying a brand, you're buying whatever their owner needs from it. Second, Never buy on the average. Panera's average is $2.5 million, and that's a real revenue number, but 55% of their franchisees are below it. And the bottom of that range is 463,000. Not very good. The average tells you what's possible. The bottom tells you what happens if you're not airtight and perfect. Both of those numbers are sitting in a document that every brand legally has to hand you before you sign. And that document is called an FDD, a franchise disclosure document. Make sure you look at it, read it, and understand it. That is exactly why we built Franzi. We have real numbers, real spread, and real franchise advisors helping you every step of the way.